All right, let's dive in.
Let's do it.
We're taking a deep plunge today into the foundational models that really shaped how we think about finance and investing.
Yeah, the real bedrock stuff.
And then we're jumping straight into how newer technologies like AI and machine learning are, well, fundamentally changing trading strategies right now.
It's a fascinating journey, isn't it? From that core theory to the absolute cutting edge of practice today.
We've got some really insightful source material here, some key excerpts that kind of trace that history.
And then really zero in on the practical side, how AI and ML are being used.
So our mission today is to unpack all of this for you. We
Hmm.
want to explore those, Nobel Prize-winning ideas.
And then look at techniques being put into action on trading desks as we speak.
It's really about understanding those building blocks first.
Exactly. And then seeing how data and tech are pushing the boundaries.
So let's start by laying that foundation.
Absolutely. I mean, finance, markets, they're ancient, right? As
Yeah.
long as people have exchanged goods, capital. But the idea of having really rigorous sort of mathematical frameworks for understanding risk and return, for designing portfolios, that's relatively new.
We're talking mid-20th century, really.
Yeah, that's when these ideas truly took root and started to formalize things.
And you could argue one of the most influential, maybe the most influential, is the capital assets pricing model, CAPM.
Definitely. CAPM's huge.
So impactful that its developers, Merton Miller, Franco Modigliani, William Sharpe, they actually shared a Nobel Prize for it back in 1990.
That tells you something, doesn't it? About the shift it represented in thinking.
What's really fascinating is one of the core implications of CAPM, especially when you pair it with the efficient markets hypothesis, the EMH.
Right. EMH basically saying all known info is already baked into the price.
The implication is that it's incredibly difficult, maybe impossible for most investors, to consistently beat the market averages.
Yeah, consistently outperforming is the holy grail, but according to this framework, it's really, really hard.
So the big takeaway for a lot of people who bought into TAPM and EMH was, well, surprisingly simple, actually.
Don't try too hard.
Kind of. Trying to pick individual winners or perfectly time the market often just leads to underperformance, especially after costs and taxes.
So the conclusion was just buy the market.
Exactly. Buy the market itself, maybe through something like a broad stock market index fund.
And that's the powerful idea that really fueled the rise of index investing, wasn't it?
Totally. You see it in books like Burton Malkiel's A Random Walk Down Wall Street that first came out way back in '73.
And then pioneers like John Bogle founding Vanguard around the same time, bringing those low-cost index funds to everyday investors.
Which, okay, presents a bit of an interesting puzzle, right?
How so?
Because hedge funds, their whole reason for being is built on the idea that outperforming an index is possible.
Ah, right. The direct contradiction.
So if that's the case, why is CAPM still so central? Why are we still talking about it?
Well, it remains really influential because it gives us a fundamental way to think about performance, a framework to dissect it.
To break down where returns actually come from.
Precisely. It lets us split returns into component parts, even if people argue fiercely about, the implications or the real-world accuracy of those parts.
And understanding those components, alpha, beta is crucial for getting a handle on modern strategies.
Absolutely, including what hedge funds are trying to do, and as we'll get into, what some of these ML models are trying to optimize or predict.
Okay, so let's get into those components then. The ABCs of CAPM, alphas, betas, and correlations.
Right. So if you just watch a stock, say ExxonMobil, ticker XOM,
Big oil company.
and compare its daily price moves to the overall market, like the S&P 500, SPX, you notice, well, they often move in the same direction, don't they?
Yeah, usually, but not always perfectly in sync.
That tendency to move together, that's what correlation captures. It measures how often the prices or the returns of two assets move in the same direction.
And it's a number, right? Goes from -1 to +1.
Exactly. Medica 1 means they always move opposite. +1 means they always move together. 0 means no real relationship in their direction.
And knowing that correlation is fundamental if you're building a portfolio.
Absolutely essential. Because if you combine assets that don't always move together ones with low or even negative correlation,
It smooths things out, reduces the overall bumps.
precisely, it dampens the portfolio's volatility,
Yeah.
lowers your risk. When one zigs, the other might zag,
Makes sense.
So if you plotted the daily percentage changes the returns of XOM against the S&P 500 on a chart, a scatter plot.
Like in figure 8.3 from our source.
Yeah, you'd see this cloud of dots, and it would generally form an upward sloping oval shape.
Which visually tells you there's a positive correlation. They tend to move together.
That's it. The pattern confirms it.
Okay, so correlation shows if they move together. What about beta? How is that different?
Beta takes it a step further. It measures the stock's price volatility relative to the market's volatility.
Relative.
Yeah.
Think of the overall market, the S&P 500, as having a beta of exactly 1.0 by definition.
So if a stock has a beta of, say, 1.5,
That means it's expected to be 50% more volatile than the market, on average.
so it swings more, both up and down.
In percentage terms, yes. Rises 1.5 times the market's rise on an up day, falls 1.5 times the market's fall on a down day, roughly speaking.
And different types of companies have different betas.
Generally, yeah. Smaller, maybe more speculative companies often have betas higher than 1.0. Big, stable, mature companies often have betas less than 1.0.
Like that Exxon example. The source says its beta is 0.77.
Right, so it moves pretty much with the market, as you'd expect for a giant energy firm, but slightly less volatile than the market overall.
And beta is actually the slope of the line you can draw through that scatter plot cloud.
Exactly, it's the slope of the regression line. And yeah, you don't usually need to calculate it yourself. You can find published betas on most finance websites.
Got it. Correlation dot move together. Beta, how much it moves relative to the market. So what's left? Alpha.
Alpha is the interesting one. It's the part of the return that isn't explained by the market's movement or by the stock's beta sensitivity to that move.
So it's the extra bit, the performance on top of what you'd expect just from its market exposure.
That's a good way to think about it. The systematic difference in performance over and above the market return adjusted for beta.
And where does that come from?
Well, theoretically, from company-specific factors, maybe a superior management, unique technology, pricing power, something intrinsic to that stock or the manager picking it.
And on that scatter plot graph.
Alpha is the y-intercept. It's where the regression line crosses the vertical axis, representing the stock's expected return when the market return is zero.
But thinking back to EMH again, if all stocks together make up the market, doesn't that mean alpha has to average out to zero across all stocks? For every positive alpha someone finds, someone else must have a negative alpha.
That's the core logic within that KMH view.
Yes.
It implies that generating persistent positive alpha, that true outperformance, is incredibly difficult.
Because the market is, on average, efficient.
Right. The argument is most of your return comes from just riding the market wave, your beta exposure. Finding that consistent edge, that alpha, is the tricky part.
Which brings us right back to the practical implications of CEPM, how fund managers think about returns.
Exactly. You can decompose a fund manager's return into those two sources. You've got the return from just being in the market, general exposure.
That's buying beta. You get that just by holding an index fund.
Right. And then you have the return potentially coming from skill, stock selection, specific factors.
That's seeking alpha.
And as we mentioned, numerous studies, especially looking back at mutual fund performance over decades.
Okay. Find very little evidence of persistent alpha.
It's surprisingly scarce, yes. Lots of studies struggle to find managers who consistently deliver positive alpha after fees year after year.
So CAPM gives us this neat little equation. Performance, market return via beta, plus company skill factors, alpha.
That's the framework.
And if you want to beat the market index, you basically have two theoretical levers, according to this model.
Which are?
Either you take on more market risk, buy stocks with betas higher than 1.0, so you amplify the market's move.
Which also amplifies your losses when the market goes down, remember? More risk.
Or you find those elusive stocks or strategies that systematically generate positive alpha.
Which, as the evidence suggests, is the really hard path.
So this raises that question again. If alpha is so hard to find, how do hedge funds operate? Their whole pitch is often about delivering alpha, or at least positive returns, regardless of the market.
Right. It forces us to look at how their strategies might fit into or try to exploit this framework.
The term hedge fund itself gives a clue, doesn't it? Hedging.
It does. The origin story, Albert Winslow Jones's fund back in 1949, was specifically about trying to achieve absolute positive returns by hedging bets, taking offsetting positions.
But the goal of the hedge isn't necessarily just raw profit maximization.
Not always. Often it's about risk management. Protecting capital if your main idea goes wrong, or even trying to make money when the overall market is tanking.
But there's a trade-off.
Usually, yes. A hedge can drag on your returns when the market is strong and your main bet is working. It dampens the upside.
So how does that look in CAPM terms? A hedged portfolio.
Okay, think simple. A portfolio's return is just the weighted average of the returns of what's in it.
So if I have 60% Exxon, 40% S&P 500 ETF.
Your return is 0.6 times Exxon's return plus 0.4 times the S&P ETF's return.
Right.
And remember, using CAPM, each asset's return is roughly its beta times the market return plus its alpha. For the market ETF itself, like SPY, beta is 1 and alpha is assumed to be 0.
Okay, so let's say I'm bullish on Exxon. I think it's going to outperform, generate positive alpha. A regular investor might just buy Exxon stock.
Right, long Exxon.
But a hedge fund might do what? Go long Exxon but short the market?
Exactly. That's a classic hedge.
Right.
Maybe you put 50% of your capital long XOM and 50% short SPY. That's dollar balanced.
Equal money on both sides, one long, one short.
Right. Now what happens? If the whole market tanks, your loss on the long XOM position is hopefully offset, at least partially, by the gain on your short SPY position.
And if the market rallies?
Your gain on XOM is offset by the loss on the short SPY.
So where's the profit?
The hope is that XOM's alpha, its performance relative to the market, is positive and large enough to make the combined position profitable, regardless of which way the market went. You're trying to isolate that alpha.
But wait, that $50 balanced example, it's not perfectly market neutral, is it?
Why do you say that?
Because Exxon's beta isn't 1.0. It was 0.77, right? And SPY's beta is 1.0.
Good point. Exactly right. That 50-50 portfolio still has some net beta exposure because the betas aren't offsetting perfectly. It would still tend to drift a bit with the market.
So some hedge funds try to get even more precise. Aim for beta balanced.
Yes. That means constructing the portfolio so the weighted sum of all the betas of all the positions adds up to 0, or close to it.
How would you do that with Exxon and SPY?
Since Exxon has the lower beta, 0.77, you'd need a slightly larger dollar position in Exxon relative to the short SPY position to make the weighted betas cancel out.
Like the source example, maybe 56% long XOM and Minical 44% short SPY.
Something like that, yeah. The goal is to make the portfolio's performance almost entirely dependent on the alpha generated by the positions, stripping out the market's general direction.
And because that alpha, even if you find it, might be quite small on any given trade or over a short period.
This is where leverage often comes into play.
Right. Borrowing money to make the position size much larger than your actual invested capital.
Exactly. It's not uncommon for institutions to use leverage of 20, 30 times or even more, depending on the strategy.
Why? To magnify those potentially small alpha returns.
That's the idea. If you can generate a small, consistent alpha, leverage blows up the dollar return.
What a big but.
It blows up the losses just as quickly if the alpha doesn't show up, or if your hedge isn't perfect, or something unexpected happens. High leverage demands extremely robust risk management. That's why it's often paired with these kinds of hedged, ideally beta-neutral strategies.
Okay. That gives us a solid framework for returns, risk, alpha, beta. Now let's shift focus a bit. How do markets actually react to information, to news?
Yeah, this is fundamental. Traders often work on the belief that getting information early or having a stronger conviction about how news will impact a price gives them an edge.
If you think bad news is coming, you sell before it hits. Good news, you buy. Seems simple.
Seems simple, but it's really not. You have to forecast how much the price will change. You need to figure out if the news is already priced in by others.
Meaning everyone else already knows or expects it.
Right. And you need to decide how long to hold the position. Will the effect be quick, or will it play out over days or weeks? Lots of variables.
And this brings us back again to the efficient markets hypothesis, EMH.
Yep. EMH throws cold water on the idea that getting information gives you a durable, reliable edge.
Because it argues the market is too fast.
Essentially, yes. The collective intelligence, or maybe just the rapid reaction, of all market participants incorporates news into prices almost instantaneously. Any obvious arbitrage opportunity disappears in a flash.
And there are different flavors of EMH, right? Weak, semi-strong, strong.
Yeah, they relate to what kind of information is assumed to be priced in. Historical prices, all public info, even private insider info. The stronger the form, the harder it suggests beating the market should be.
So how do academics or quants actually study this? How prices react to specific news events?
They use a methodology called event studies. It's a specific technique designed to isolate and measure the impact of a defined event, like an earnings announcement, a merger, maybe even regulatory news on stock prices.
Our source mentions a big one, a meta-study by McKinley from 1997.
Right, that was influential. It looked at the combined results of almost 1,700 different event studies focusing on company-specific news.
And what did that large-scale look reveal? What are the key takeaways, like in figure 12.1?
Okay, first big thing. The market reacts fast. Very fast. Right around the announcement day, prices moved sharply in the expected direction.
Bad news, price drops. Good news, price pops.
On average, yeah. About a 1.5% drop after bad news, a 2% rise after good news, very quickly.
But the really interesting part, maybe, is what happened before the news hit.
Exactly. The study showed a clear pattern of drift leading up to the event. Prices tended to creep up slowly before official good news was announced.
And slide down gradually before bad news.
Right. Now, how do you interpret that?
Well, the EMH folks would say it's information leakage, wouldn't they?
That's the common interpretation. Some traders are figuring it out early or getting whispers and trading on it before the public announcement. And this pre-event trading actually accounted for about half of the total price move associated with the event.
Half the move happened before the news was even official. Wow.
Yeah. The counter-argument might be something about confirmation bias, but the leakage idea is strong.
Okay, what about after the event? Did prices just settle at the new level?
Not entirely. The study also found post-event patterns. Stocks that popped on good news tended to drift slightly higher still in the following weeks.
And stocks that dropped on bad news?
They tended to recover about half of that initial loss, suggest maybe an initial overreaction or subsequent information confirming the path. These are sometimes called post-event drifts or overshoots.
So understanding these typical patterns, the pre-drift, the immediate reaction, the post-drift, they could be valuable for a trader.
It could potentially inform strategy. Even if EMH says the opportunities are fleeting, knowing the average reaction pattern might help you anticipate movements, set profit targets, or manage risk around news events.
It shows how information gets absorbed, even if it's messy.
Exactly. It's about the dynamics of that absorption process.
So how would someone actually do an event study today, say, using a quantitative tool?
Our source gives an example. First, you define your universe. Maybe the S&P 500 stops during, say, 2008, 2009.
Okay, specific group and time period.
Then you define the event. In their example, the event was a day where a stock's return underperformed the market, SPY, by at least 5%, a significant single-day drop relative to the trend.
And they found almost 500 instances of that happening in that period.
487, yeah. Then, for each of those events, you look at the stock's return relative to the market for, say, 20 days before and 20 days after the event day.
And average all those relative returns together.
Exactly. You average across all 497 events to see the typical pattern. Figure 12.2 in the source shows that average curve.
And does it look like the McKinley findings?
Very consistent. You see about half the relative loss occurring before the negative 5% event day, the other half on the event day itself, and then a partial recovery, maybe half the loss clawed back in the days following.
So it really illustrates how you can use this method to quantify market reactions.
Definitely. But the source rightly adds a big caveat. Don't generalize wildly from one study. Market conditions change. Different events have different patterns.
But hedge funds or quant shops would use this methodology extensively.
Oh, absolutely. To identify potential trading signals, to test hypotheses about what drives prices, and to backtest strategies based on those signals.
They might say, let's test buying stocks after they hit the lower Bollinger Band, but only if the overall market is strong, and run an event study on that specific setup.
Precisely. They use simulators and historical data to see if the pattern holds up and if it would have been profitable historically.
And these studies can help optimize things like how long to hold a trade?
Yes. Looking at that figure 12.2 again, the average relative return peaks maybe 15-20 days after the event. But maybe the best risk-adjusted return, the peak Sharpe ratio, occurs much earlier, perhaps only 5 days out.
So the analysis helps fine-tune the strategy.
That's the goal. Quantitative analysis driving strategy design and optimization.
But even with all this data, all this automation, there's still a need for human judgment.
Critical. The source emphasizes this strongly. Models can be based on faulty assumptions, code can have bugs, data feeds can be wrong, simple typos, fat finger errors have cost firms fortunes.
So you need that human sanity check overlay.
Non-negotiable, especially if the system is trading automatically. Someone needs to monitor, understand the risks, and have the ability to intervene. History is littered with examples of quant strategies blowing up spectacularly.
Okay. So we've journeyed from KPM's view of risk and return through how markets process news via event studies. Now, let's really pivot to the present and future. AI and machine learning in trading. Why the huge buzz right now?
It feels like a perfect storm, technologically speaking. You've got massive increases in computing power, just orders of magnitude more than even a decade ago.
Moore's law still kicking in.
Plus, an absolute explosion in data, not just market data, but alternative data, unstructured data, news feeds, social media sentiment.
And the cloud makes it easier to store and process all that.
Exactly. Cloud services provide access to powerful computing and storage on demand. Put it all together, and complex ML techniques that were purely academic before are now becoming practical tools for finance.
So asset managers are definitely interested. We hear about it constantly. But the sources suggest maybe adoption isn't quite as widespread or deep as the hype.
There seems to be a bit of a lag, yeah. Some surveys from a couple of years back showed maybe only a quarter or so of buy-side firms were regularly using ML or AI in actual investment decisions.
But things are moving fast.
Anecdotally, yes. You hear about huge investments in data infrastructure, hiring data scientists, upskilling existing quant teams. The interest and the effort seem very high now.
What are the biggest hurdles they're facing in actually implementing this stuff effectively?
It's often twofold. One is just getting the technology and processes right to capture, clean, and manage these vast, messy data sets, garbage in, garbage out, right?
Right. Data quality is huge.
And the second is having the right expertise. You need people who understand both finance and machine learning deeply enough to build meaningful, robust models. That skill set is still relatively scarce and in high demand.
And interestingly, the source notes that for many actual traders on the buy side, their biggest day-to-day headache isn't necessarily finding the perfect signal.
It's sourcing liquidity, finding someone to take the other side of their large trades without moving the price against them.
Yeah. And that's not a problem that a pure statistics algorithm easily solves by itself.
True. Liquidity is more about market structure, relationships, timing, reading the flow. ML can help around that, maybe predicting impact, but it doesn't magically create counterparties.
So what are the key advantages ML does bring to the table? Where does it really shine?
Its superpower is finding complex, non-linear patterns and subtle correlations in enormous data sets. Things that a human brain or even traditional statistical models would completely miss.
Uncovering hidden relationships in the data.
Potentially, yes. Relationships that might offer new predictive insights into market behavior, execution costs, or potential risks.
Are we seeing a shift in the skills needed on a trading desk?
Definitely. There's this rise of the quantamental trader, or maybe quasi-data scientists, as the source puts it, people who bridge the gap between traditional finance and modern data science.
Using open source tools.
Yeah, leveraging powerful libraries like scikit-learn and Python to build custom solutions, maybe teach algorithms based on complex ML signals, or ways to extract insights from, say, satellite imagery or Xing data.
Our source material then goes into some very specific use cases, showing concrete examples. But before we get there, it raises a really important caveat.
Yes, this is crucial. We have to remember that humans and computers think differently. Humans use intuition, experience, heuristics, context.
And cognitive biases.
And biases, absolutely. ML models, on the other hand, are entirely dependent on the data they're trained on.
And the humans who build them.
And the humans who build them. Data quality varies wildly, especially in finance. And every choice a human makes in designing the model, which features to include how to clean the data, which algorithm to use, introduces potential variability and bias.
Plus, some of the most powerful ML models, like deep neural networks, can be black boxes, right?
Exactly. They might give you a great prediction, but it can be incredibly difficult to understand why they arrived at that prediction.
Which isn't great for trading, where you need to understand the logic and the risks.
Generally not ideal, no. That's why data science best practices really stress transparency and interpretability. Documenting data sources, cleaning steps, feature choices, model selection, validation results, all of it.
You need to be able to trust it and fix it if it breaks.
Precisely.
Okay, with that crucial context, let's look at the first specific ML use case, feature importance.
Right. This seems to be a very common starting point for many firms dipping their toes into ML for trading. It's conceptually linked to something traders already do, transaction cost analysis, or TCA.
TCA is about looking back at past trades to see what drove the execution costs, right?
Yeah, historically it was more observational, breaking down costs by factors like, was it a liquid stock? Was the market volatile? How big was the order? How wide was the bid-ask spread?
Useful for planning future trades and also proving to clients or management that you executed well.
Exactly. And that trust element is key. You build confidence by showing you understand the basics before introducing complex ML. A client might then ask, okay, but are we missing something? Are there other cost drivers?
And feature importance is the ML way to answer that.
Pretty much. Instead of just looking at a few predefined factors, feature importance uses an ML model to analyze potentially dozens or hundreds of data points related to a trade.
And it ranks them. Tells you which ones had the biggest statistical impact on the outcome, like the final cost.
That's the idea. It helps traders focus their attention on the handful of metrics that actually seem to matter most for a particular type of trade or market condition.
So it's like using ML to confirm or maybe challenge the trader's intuition and the traditional TCA factors.
Yeah, it bridges that gap. It connects that observational analysis and human experience with statistical validation of patterns, and it can inform pre-trade decisions or even automated routing logic.
The source gives an example from Harris Associates.
Yes, Jason Siegendorf there talked about using it alongside an auto-routing system for low-risk trades. They wanted to confirm their intuition that order size was key for defining low risk, but also see what else mattered.
And what did they find?
Feature importance confirmed order size was indeed critical, but it also highlighted other factors, other trade characteristics that were surprisingly influential on costs, things they perhaps hadn't been paying as much attention to.
Which makes sense. A human can only juggle maybe 3 or 4 factors consciously in real time.
Right. ML can sift through far more data to find those subtle drivers.
What kind of ML models are good for this?
The source suggests supervised random forests are often used, partly because they have built-in methods for calculating feature importance. Linear regression is sometimes used too, because people are familiar with interpreting its coefficients.
And the process involves several steps, starting with data cleansing and normalization.
The grunt work, often the most time-consuming part. Getting the data accurate, handling missing values, scaling features so the model can process them properly.
Then chunking data, breaking it down.
Yeah, analyzing subsets makes sense. Do cost drivers change in volatile markets versus calm ones? Or for large cap versus small cap stocks? Or for different order types? Chunking helps see that.
Third, data labeling and test train splits. You need known outcomes for supervised learning.
Right. Your label might be the final transaction cost. You train the model on, say, 70% of your historical data, the training set, and then see how well it predicts costs on the remaining 30%, the testing set that it hasn't seen before, checks for overfitting.
Fourth, selecting features wisely. Don't just throw everything in.
Avoid the kitchen sink approach. Use some domain knowledge. Remove features that are highly correlated with each other, as that can confuse some models.
Fifth, choosing the model and training it, using libraries like scikit-learn.
Yep, random forest regressor is mentioned as a good choice for predicting a continuous value like cost. The training process finds the patterns.
And finally, selecting the feature importance approach, because there are different ways to calculate it.
Yes, Exhibit 1 in the source material shows an example comparing a few methods. They differ in speed, potential biases, and computational cost. But the output is similar, a ranked list showing which factors mattered most. In that specific example, things like trade horizon, traded value, and historical volatility came out on top.
Okay, moving to use case 2, semi-supervised learning for clustering. This tackles a different problem, messy or missing data labels.
A huge issue in finance. Data often comes from different systems, tags might be inconsistent, missing, or just free-form text. Makes analysis hard.
And ML models often need clean, structured tags to learn effectively. So this is about using ML to essentially create or fill in those missing tags.
That's the core idea. The specific example was trying to figure out the commission rate type, like was it execution only or bundled with research, when that tag was missing from the data. It shows some creativity in using what data you do have.
But the technique applies more broadly.
Oh yeah. You can use clustering to group similar orders or funds based on characteristics, even if they lack explicit labels. Maybe inferring investment style based on portfolio holdings if the fund isn't tagged, or guessing if a trade likely involved trader discretion based on execution patterns if that flag is missing.
And because they might only have a small amount of data that is properly labeled.
They need unsupervised or semi-supervised methods. Unsupervised works with no labels, just finding natural groups. Semi-supervised uses a small labeled set to help guide the process for the much larger unlabeled set.
Data prep here involved parsing weird internal codes.
Yes, Exhibit 2 shows trying to make sense of things like broker codes, like broker AHT, maybe parsing that into a more meaningful category like not execution only. A big challenge is these codes aren't standardized across firms at all.
So for a fully unsupervised approach, what model works?
You need something that can handle mixed data types numbers like commission rates, categories like country, or the parsed broker tag. K-means works for numbers, K-modes for categories, and K-prototype tries to combine both.
And the output is just cluster assignments. Like this trade belongs to cluster 1, that one to cluster 2.
Right. Then you look inside the clusters. If cluster 1 is dominated by trades are execution only, you infer that most trades in cluster 1 are likely that type. Exhibit 3 shows this kind of outcome.
So they achieved the goal of identifying the likely execution-only trades, even without perfect labels.
They did. But then, intriguingly, the model builder found a bit more labeled data than they first thought.
So they tried a different approach.
Yeah, they reran it using a semi-supervised technique. Trained a standard classification model on the small labeled set, then used that trained model to predict the labels for all the unlabeled data.
And did the results match?
Reassuringly, yes. Both methods gave similar estimates for the average execution-only rate. That kind of reproducibility is great. It builds confidence that the underlying pattern is real and the techniques are working.
Use case 3, natural language processing NLP for free-form text, tackling those messy trader notes.
Exactly. Think about a portfolio manager typing instructions into a system. Target this order for the close, part of a program trade. Work this slowly, avoid impact.
Humans get it, but computers struggle with that ambiguity.
Right. NLP aims to automatically understand that unstructured text and convert it into structured, usable tags, like instruction target close, attribute program trade, urgency low.
Why is that helpful? What can you do with those tags?
Loads of things. Post-trade, you can analyze if trades with certain instructions consistently cost more or less. Pre-trade, maybe you feed that instruction tag into a model recommending the best execution algorithm. You can apply it to any free text field you have.
And the ML model of choice here was Google's BERT.
Yes, BERT, bidirectional encoder representations from transformers. It's become very popular.
Why BERT? What makes it good for this?
Its key advantage is understanding context better. It looks at words in relation to all the other words in the sentence, both before and after, not just sequentially. Plus, it's open source and comes pre-trained on huge amounts of text data.
And there are even specialized versions, like FinBERT for financial text.
Exactly. You take the pre-trained BERT or FinBERT and then fine-tune it on a relatively small set of your own trading notes that you've manually labeled with the tags you want.
How do you run it?
You can set it up internally using standard data science tools like Jupyter Notebooks and Python libraries, or often more quickly using cloud-based AI services like AWS SageMaker or Comprehend.
And the output is tagged predictions.
Yes. It reads the note and predicts the probability that it matches each of your defined tags, like target close.
Okay, use case 4. Predicting transaction costs or market impact. This sounds like the holy grail for execution analysis.
It's definitely a core challenge. The goal is to estimate, before you trade, how much executing that order is likely to cost you, either in commissions or by moving the market price against you, market impact.
But the source flags this is really difficult because of data noise.
Extremely difficult. Exhibit 4 illustrates it perfectly. You can find pairs of trades that look virtually identical on paper, same stock, same size, same time of day, similar market conditions, yet they end up having vastly different realized transaction costs.
Why? What causes that noise?
So many hidden factors. Maybe this specific strategy used by the broker, the actions of other unseen market participants at that exact moment, subtle differences in liquidity just milliseconds apart. Things that often aren't captured cleanly in standard data sets.
So trying to build an ML model on a broad, noisy database didn't work well initially.
The source says early attempts using a large global peer database were largely unsuccessful. The noise just drowned out any reliable signal.
But they found success when they focused the ML model on cleaner, more homogeneous data, specifically from algo wheels.
Yes, that seems to be a key breakthrough. Let's quickly explain an algo wheel. It's an automated system many large firms use. A trader selects a general strategy type, like VWAP or implementation shortfall, and the wheel automatically and randomly routes pieces of the order to different brokers, using standardized algorithms from each broker for that strategy type.
So it generates lots of relatively comparable trades across different brokers.
Exactly. You might get, say, 300 VWAP orders sent to broker A, 300 to broker B, etc. over time. This creates a much cleaner data set for comparing broker performance, or in this case, for training an ML impact prediction model.
So the ML model could predict impact reasonably well when trained on just the algo wheel data.
Yes. Applied to those more controlled, homogeneous flows, the models provided useful cost estimates. Firms use this to compare brokers fairly on the wheel or analyze their own internal execution quality.
The source mentions Enrico Cacciatore at Voya Financial, using ML for this.
Right. His point was you need to account for the fact that different brokers might get slightly different mixes of easy versus hard orders through the wheel. An ML model can help handicap them, adjusting for order difficulty to get a fairer comparison of their execution skill.
And again, random forest turned out to be a good model choice here.
It performed well in their tests, handling the mix of numerical and categorical data effectively, and being relatively easier to explain and troubleshoot compared to maybe more complex models like neural nets.
And this use case really highlights the importance of peer review in model building.
Absolutely critical. Having knowledgeable people outside the core model building team review and challenge the assumptions, the data, the methodology, it's invaluable for catching blindful flaws.
Like that indigeneity issue they found.
Perfect example. The model initially included order horizon, how long the broker took to execute, as a predictive feature, and it improved accuracy.
But the reviewer pointed out the broker controls the horizon.
Exactly. So including it would muddy the waters if your goal is to assess the broker's skill independent of how long they chose to take. You'd be mixing the input and the outcome.
So they removed the feature, even though it made the model slightly less accurate.
Yes, because the objective of that specific model was fair broker comparison. It shows how human judgment about the purpose of the model overrides pure statistical accuracy sometimes. That's sophisticated model building.
Okay, last one. Use case 5. Trading strategy recommendation. This feels like the culmination.
It is. You're moving from analysis and prediction to actually suggesting an action, which means the stakes are higher. A bad recommendation costs real money.
What data goes into this?
Typically, all the algorithmic trades captured by the firm's execution management system. You need pretty comprehensive internal data.
Now, how does it work? What's the method?
It builds on the previous steps. Feature importance identifies the key drivers. Order details, ticker, size, sector, maybe enriched with tags from clustering or NLP, like manager urgency, combined with real-time market data, volatility, volume, spreads compared to normal.
And then you train separate models for each available trading algorithm.
Right. You might train a random forest model on historical data just for your VWAP algorithms, another one for your implementing shortfall algos, another for liquidity-seeking ones, another for dark pool strategies.
So when a new order comes in
The system runs its characteristics through all those trained models.
and gets a predicted cost for using each different algorithm.
Exactly. The output might be predicted cost for this order using VWAP is X, using IS is Y, using Liquidity Seeker is Z.
And the system can then recommend the lowest predicted cost option.
It could simply highlight the cheapest, or it might show the trader the predicted costs and maybe the expected cost variability for several options. It might even flag an order as potentially high cost across all strategies, suggesting it needs manual handling by a human trader.
That's quite a leap from analysis to recommendation.
It really is. But as the source reminds us, getting these things right is hard. Many ML experiments fail.
It's iterative, creative, collaborative.
And those challenges we discussed earlier are always present. Biased data is a killer.
Right. If your training data isn't representative, your predictions will be skewed.
Training a VWAP model mostly on easy liquid trades will make it look artificially cheap when applied to a difficult illiquid stock. Dealing with bias is critical.
And model interpretability, the black box issue, remains a concern, especially for recommendations.
You want to understand why the model is suggesting a particular strategy. Transparency in how the model was built and what drives its decisions is vital for trust and effective use.
And it always comes back to the human element.
Always. ML is a tool. Its effectiveness depends on the data quality and the skill of the humans designing, building, validating, and overseeing it. Human sanity checks, especially when automating decisions, are absolutely essential.
Wow. Okay, so we've really covered a huge amount of ground today.
We certainly have.
We started way back with those foundational frameworks like CPM, giving us a language for risk and return, beta and alpha.
Then explored how markets absorb news, looking at event studies and the implications of the efficient markets hypothesis.
And then we dove headfirst into the current wave, AI and machine learning transforming trading.
Looking at specific use cases, feature importance to find drivers, clustering, and NLP to handle messy data, prediction models for costs, and even strategy recommendation engines.
It really shows the power of bringing data science techniques to finance.
Absolutely. Understanding those core concepts, alpha, beta correlations, still gives you that fundamental lens. Knowing about EMH helps you appreciate why consistently beating the market is so hard.
And seeing these ML applications in detail reveals the sophisticated tools being built and deployed right now, from refining execution to potentially finding new sources of edge.
It's definitely complex, no doubt about it. But breaking it down shows how these powerful ideas connect, from index funds born out of theory to high-tech trading desk leveraging AI.
So as we wrap up this deep dive, maybe here's a final thought for you, the listener, to ponder.
Go for it.
As these ML models get better and better at predicting costs, identifying patterns, and even recommending specific trading strategies, where does the experienced human trader's intuition, their gut feel, their judgment, really fit in?
The human versus the machine.
When do you trust the model's output implicitly? And when does your own conviction, built over years of experience, lead you to override that recommendation? And maybe most importantly, what can we learn from analyzing those moments of divergence?
That intersection is fascinating, isn't it? Where data-driven insights meet human experience. Definitely something to chew on.
Until our next deep dive.